All right, so this is money and banking part two. I don't know how many parts I'm going to have, but I changed clothes and I have an extra special surprise. My old Lehman Brothers t-shirt that I still fit in from when I worked at Lehman before all that money went poof. Speaking of monetary policy, big failure right there. So now what we're going to do is we're going to go over banks and how banks create money. So, in order to understand this, you have to understand some basic accounting. All right, so this is going to be the basic accounting part. And I didn't have the intro because it's a three-part series. So look at the part one for the intro. What is a what are accounting sheets? What is a balance sheet? What is an income statement? All right, so let's go into first of all, why do you need accounting? You need accounting to keep track of how your business is doing, right? So any business, or whether you're a person or a business, you have to kind of keep track of how much you have. Are you in debt? Are you in surplus? Are you making money? Are you losing money? How do I keep track of this? Well, that's where accounting comes into play. And accounting basically tells a business how it's doing. All right. So what is it? What is accounting? What are the basics? All right. So there's two basic, I'm not going to go into an entire accounting course, but the two basic things, and let me do this here. All right. So the two basic sheets that you have in accounting is income statement and balance sheet. All right. And all of them use a T account. All right. And I'll go over what a T account is. But an income statement, let me do it in a pen that works. All right. An income statement if I could write, an income statement shows profit and loss. That's like, did you make money? Income statement. So on an income statement, you have revenue and expenses, right? So if you have revenue and expenses, basically earnings and cost of goods sold. So ideally, your revenue is greater than your expenses, and at the end, you will have a profit, right? You will have net income. You will have made money. Doesn't always happen. Sometimes you're losing money. Right now, a lot of companies are going to be losing money, but that's a temporary thing. You can absorb some of those losses as long as your balance sheet is in order. So income statement is temporary profit loss given revenue and expenses. All right, now a balance sheet, which is more important for the AP test that we're studying for. A balance sheet shows, and whether it's an individual balance sheet or a company balance sheets, assets and liabilities. Okay, assets and liabilities. What is an asset? An asset is anything you or the business owns. So an asset is something you own. A liability is something you owe. Let's make that E better. A liability is something you owe. And as its name implies up here, balance sheet, a balance sheet must balance. The two columns, you see how the T account is there. On the left is always assets, on the right is always liabilities. The two sides must balance. So if you have an entry in the left side, you must have an entry on the right side. That way, at the end of the month, you know the balance sheet's not off. You know you haven't made a mistake. So you can have a balance sheet of an individual person, right? So let's just, I don't know, I'm going to come up with this as is. So if this is, you know, my balance sheet, assets, sorry, liabilities, this pen obviously. Let me try to undo that so it actually looks presentable. Undo, undo. Control Z, I can do that. Control Z, Z, Z. Control Z, Control Z. All right. Looks much better now. Okay, you got assets and liabilities. So I might have a savings account. I might have cash. Let's say $1,000 savings. That's an asset because I own that. I have $1,000 in a savings account. I might have a $300,000 house. Don't think I'm bragging. I'm not making money. It's a hypothetical. $300,000 house. House is an asset. In this case, I'm not renting. I own. So therefore, it's an asset. I own it. I might have a $20,000 car. Automobile. All right, so these are three basic assets. You own them. Now, I said it doesn't look like they, and maybe I have a 401k. Maybe I have $100,000 in my 401k. That's a retirement plan. So, do both sides equal? No, they do not. You have to have an offset to each of those. So the house, the offset is your mortgage. You probably borrowed money, as I did, to buy your house. So let's say I have $250,000 mortgage. All right, so that's the offset. The car is a very unique thing. When you go in personal finance, a car is not something you should really buy a really expensive car unless you can write it off because it's one of the few assets that depreciates. The second you borrow money for that, it goes down in value and it's negative against your balance sheet. That's how a lot of people go broke is you buy a $500,000 car and then the second you step on the gas pedal, that car goes down and meanwhile you borrowed all that money to buy it. Not a good investment even though I'm a car guy, I love cars, but $20,000 car, let's say I borrowed to buy that, let's say I borrowed 24,000, okay? And it's car loan. I don't know how old the car is, but I have a $24,000 loan. The car is worth 20 now. 401k, there's no real offset to that. I've been saving in that for a while. So now this gets into both sides don't equal, right? So we have 300, 430,000 over here. 430,000 total assets. And I only have, well, let's make this 25 so it's easier. 275,000 over here. So both sides don't equal. Well, that's a good thing to have on a personal balance sheet because there's one more, line item, right, called net worth. So my net worth, in order to balance these, net worth, all right, is in this case, what is it, 25, 125, 155,000. My net worth is 155,000 if I did my math right. So if you add 275, 13, yeah, that should work. So my net worth, so that's when people say I'm a millionaire, okay? That doesn't mean you have $1 million car or $1 million house or you made $1 million last year. That does not constitute a millionaire. A millionaire is when your assets are worth $1 million more than your liabilities, right? That means you own $1 million more stuff than you owe, all right? And this is how a lot of sports guys, if you want a great documentary to watch, ESPN broke. I think it's a 30 for 31. A lot of people who make more money than any of us will see in our lifetime, sports guys, they go broke. Within 5 years of leaving the NBA or NFL or Major League Baseball, they're broke. How is that possible? Because of this, because their liabilities, their lifestyle was not compatible. And once their income drops, their liabilities are way more than their assets, and that's the definition of, if you're a company or an individual, Chapter 7 or Chapter 11 bankruptcy. So in this case, we have a positive net worth. A net worth is kind of the size of your bank account, essentially, your gross. You have money, in case any, like, something goes wrong, you start liquidating your house and all this stuff, you can liquidate and have money left over. If you had to liquidate your assets and pay off your liabilities, you would have money left over. Now, for a business, okay, same thing. A business, you have to have assets and liabilities. All right, so you have a balance sheet in a business, you have assets and liabilities. All right. But in the business's case, it's flipped, right? Because the mortgage would be a liability to me because I owe it back to the bank. A loan to a bank is an asset, right? Because they own it, right? If I don't pay that mortgage, they take my house. So that's an asset to them. A savings account or a checking account to us is an asset. To a bank, it's a liability. That's called a demand deposit. Why? Because they have to give it back upon demand. So that's the number one liability for banks is demand deposits. So, and cash would be an asset because they have the cash, even though they might owe it back to us. So we got cash, we got loans, we got demand deposits. And you might have, buildings, you know, building, land and equipment, land, equipment. So you might have a bunch of assets, a bunch of liabilities, but bottom line is these two have to balance. Again, balance sheet, these two have to balance. So if they don't balance on the good side, your asset, if you're a business, your assets outstrip your liabilities. You have to have that actually, otherwise you're bankrupt. But if your assets outstrip your liabilities, there is a way to balance that, and that's called owner's equity. Same thing as if your house is worth more than you own, it's called equity. Owner's equity is the size of your business. So if you want, you could, look up any one of these companies out here. I don't know, just pull up any random company. Google, let's see, APL. If you look at, I'm trying to pull this up here. So all of these things are public. So if you, for example, pull up Apple here, I assume if you're a young person and you're in a macro class, you've heard of the company Apple. So if you look at that, you have historical data profile. Here's financials. So if you click on financials, you'll see exactly what I'm trying to tell you. And I'll get into like banking and specifically how it affects us. But if you click on financials and it actually works, here's your financials, income statement, exactly like I told you. And they have years of income statements. They have revenue. This is how much money they made in, it's in thousands. So this would be thousands. This would be, so it's what, 267 billion, I guess. And then you have operating expenses, right? So that's their total operating expenses. So you have revenue, cost of revenue, you have gross profit. And then down here is what you're looking for. This is net income. That's how much Apple as a firm made last year or last TTM. I don't know what TTM, but if you look at the statement ending in, here's the year over year, 9/30/18 to 9/30/19. So in that year-long period, Apple made, I want to say $55 billion, I guess. That's thousands. Yeah, so $55 billion. It's a very profitable company. All right. And then you have earnings per share, you have diluted earnings per share, EBITDA. There's a whole bunch of stuff there, but you just have to know what's on an income statement. Now they also have a balance sheet. All right. So on the balance sheet, if you click on it, see, they don't have it as a T account. They have it so you can look at it on the internet. So assets, you see the assets, current assets, cash and equivalents, other short term. So they have total cash. Here's total current assets. They have more assets, property, plant, and equipment. All right, so here's total assets. That's their total amount of assets. And then they have liabilities, current debt. They owe back accounts payable. This is what they have to pay out. Total liabilities. So the Apple's in a good position because it looks like, again, if my zeros are right, thousands, $338 billion in assets and $105 billion in liabilities, so they're doing pretty well. All right. Total liabilities. Sorry, that was total current liabilities. 248 billion in liabilities, 338 billion in assets. So they're still doing well because they have owner's equity of $90 billion. They're a fairly large company. Okay, so that's Apple is doing fairly well, but I just wanted to show you that that's a balance sheet. That's how it works. What you owe versus what you own, and now next step is how can you use that to create money? How do banks specifically? What are you responsible for on the test in monetary policy? So we'll do that. Krause University coming at you.